The Checkpoint is presented by GM Pharma, the first international multinational pharmaceutical company in Georgia. GM Pharma, to serve those who need it most.
Meanwhile, the IMF has published an updated outlook for world economic growth. According to the IMF, a tentative recovery in 2021 has been followed by increasingly gloomy developments in 2022 as risks began to materialize. Global output contracted in the second quarter of this year owing to downturns in China and Russia, while the U.S. consumer spending undershot expectations. Several shocks have hit a world economy already weakened by the pandemic, higher than expected inflation worldwide, especially in the United States and major European economies, triggering tighter financial conditions, a worse than anticipated slowdown in China, reflecting COVID-19 outbreaks and lockdowns, and further negative spillovers from the war in Ukraine. The baseline forecast is for growth to slow from 6.1% last year to 3.2% in 2022, 0.4 percentage point lower than in the April 2022 World Economic Outlook. According to the IMF, lower growth earlier this year reduced household purchasing power, and tighter monetary policy drove a downward revision of 1.4 percentage points in the United States. In China, further lockdowns and the deepening real estate crisis have led growth to be revised down by 1.1 percentage points, with major global spillovers. And in Europe, significant downgrades reflecting spillovers from the war in Ukraine and tighter monetary policy. Global inflation has been revised up due to food and energy prices, as well as lingering supply-demand imbalances, and is anticipated to reach 6.6% in advanced economies and 9.5% in emerging market and developing economies this year, upward revisions of 0.9 and 0.8 percentage points, respectively. In 2023, disinflationary monetary policy is expected to bite, with global output growing by just 2.9%. The risks to the outlook are overwhelmingly tilted to the downside. The war in Ukraine could lead to a sudden stop of European gas imports from Russia. Inflation could be harder to bring down than anticipated, either if labor markets are tighter than expected or inflation expectations anchor. Tighter global financial conditions could induce debt distress in emerging market and developing economies. Renewed COVID-19 outbreaks and lockdowns, as well as a further escalation of the property sector crisis, might further suppress Chinese growth, and geopolitical fragmentation could impede global trade and cooperation. A plausible alternative scenario in which risks materialize, inflation rises further, and global growth declines to about 2.6% and 2% in 2022 and 2023, respectively, would put growth in the bottom 10% of outcomes since 1970. With increasing prices continuing to squeeze living standards worldwide, taming inflation should be the first priority for policymakers. That's what the IMF says. Tighter monetary policy would inevitably have real economic costs, but delay will only exacerbate them, IMF says. Targeted fiscal support can help cushion the impact on the most vulnerable, but with government budgets stretched by the pandemic and the need for a disinflationary overall macroeconomic policy stance, such policies will need to be offset by increased taxes or lower government spending, IMF believes. Tighter monetary conditions will also affect financial stability, requiring judicious use of macroprudential tools and making reforms to debt resolution frameworks all the more necessary. According to the IMF, policies to address specific impacts on energy and food prices should focus on those most affected without distorting prices. And as the pandemic continues, vaccination rates must rise to guard against future variants. Finally, IMF says mitigating climate change continues to require urgent multilateral action to limit emissions and raise investments to hasten the green transition.
The Checkpoint is presented by GM Pharma, the first international multinational pharmaceutical company in Georgia. GM Pharma, to serve those who need it most.